Back to Curious Commerce, Capital Budgeting Series, Part 21. In the previous video, we understood the concept and calculations of ARR, but now comes the real managerial question. Is ARR a perfect method? Can a company completely depend on ARR while making investment decisions? In business, every method looks attractive at first, but a good manager should not only know advantages must also understand the limitations. Today's video is very important because we are going to critically evaluate ARR method. We will see where ARR is useful, where ARR is fail, and how real managers use it practically. By the end of the session, you will think like a professional financial manager. Dear students, in finance, there is no perfect method. Every capital budgeting technique has strengths and weaknesses. For example, payback period focuses on recovery, ARR focuses on accounting profit, net present value focuses on the present value, IRR focuses only on rate of return. Similarly, accounting rate of return is also useful but incomplete. Why it is called as the incomplete method? Because ARR ignores some important financial realities like time value of money, timing of profit, and cash flow importance. So, managers should never blindly rely on the method. A wise manager compares the different techniques before taking the final decisions. That is why financial management is not just mathematics, it is intelligent decision making. Before criticizing ARR, let us first appreciate why many companies still use it. ARR become popular mainly because it is simple. It uses accounting informations and it helps in quick comparison. Especially in small businesses and beginners prefer ARR because the calculations are easy. In many interviews and examinations also, ARR is frequently asked because it is one of the most basic capital budgeting techniques. Now, let us discuss each advantage separately. One major strength of ARR is simplicity. Dear students, compare ARR with method like NPV or IRR. In NPV, discounting is required. Present value factors are required. Time value calculations are involved. But ARR is very straightforward. The formula is simple. ARR equals average annual profit divided by average investment, all multiplied by 100. Even beginners can easily understand it. Managers also like quick tools during preliminary analysis. Suppose a company receives 50 proposals. Management may first use ARR to filter projects quickly. That is why ARR acts like a fact screening tool, simple method and save money. In business, time itself is valuable, right? The second advantage is based on the profit. ARR uses the accounting profit. This is important because companies already prepared the profit and loss account, balance sheet, and financial statements. So, managers can directly use available accounting data. ARR also aligns with the performance evaluation system. For example, if a department generates higher accounting profit, ARR will also show better performance. Investors, accountants, and executives often understood profit better than complicated discounted cash flow calculations. So, ARR becomes convenient for internal reporting. That is why many organizations still include ARR in managerial reports. Third advantage is easy comparison. Since ARR is expressed as percentage, comparison becomes easy. Suppose project A and B. Project A gives 20% ARR, project B gives ARR of 25%. Immediately, managers can identify which project looks more profitable. 20% is less than 25%. It means that project A is lesser than the project B. This helps in ranking the projects. In competitive business environment, quick comparison is very important, especially when multiple investment options are available. Percentage based analysis becomes easy to understand. That is why ARR is popular in comparative analysis. Comes the most important part, that is the limitations. Students, remember one important sentence. A method becomes dangerous when people understand only its advantages but ignores its weakness. ARR has three major limitations. It ignores time value of money. It focuses on accounting profit instead of cash flow. It ignores timing of profit. Because of these weaknesses, ARR may sometimes produce misleading decisions. Now, let us study each limitations carefully. This is the biggest weakness of ARR, that is no time value. ARR ignores time value of money, but what does time value means? Money today is more valuable than money received in future. Why? What is the reason? Because today's money can be invested, it earns the interest, it fight against the inflation and reduce uncertainty. Suppose you receive 1 lakh today or 1 lakh after 3 years. Both are same, right? But practically no. Today's money is more valuable, but the ARR treats them equally. That creates inaccurate decisions. This is why modern financial management gives huge importance to discounted cash flow methods like NPV and IRR. Another major problem is that ARR uses accounting profit instead of cash flow. Dear learners, profit and cash are not the same. A company may show accounting profit but still face cash shortages. For example, credit sales increases the profit, but cash may not be received. Similarly, depreciation reduces accounting profit, but it does not involve actual cash outflow. Managers need cash for salary payments, loan repayment, business expansion, and survival itself. That is why modern capital budgeting focuses more on cash flow than accounting profit. The third limitation is ARR also ignores timing of profit. Suppose two projects generate same total profit, but project A earns profit early, project B earns profit very late. In reality, early profits are better because money received earlier can be reinvested. But ARR may treat both projects equally. This again proves ARR does not fully reflect real business values. Timing matters greatly in finance. That is why professional managers prefer methods like NPV and IRR. What should managers do? Should they completely reject accounting rate of return method? No. ARR is still useful, but only as a supplementary tool. Managers usually combine ARR with NPV, IRR, payback period, and risk analysis. This creates balanced decision making. ARR can provide quick profitability insight, but final investment decisions should consider cash flows, time value of money, risk factors, and strategic importance. Professional finance is always about combination of analysis method. Let us quickly revise today's discussion. ARR is simple, easy to understand, useful for comparison, but ARR also has important weaknesses. It ignores time value of money, it ignores cash flow value, it ignores timing differences. Therefore, ARR should never become the only basis for decision making. It is useful as supporting method, not as complete method. This understanding is very important for examination, interviews, and real business situations. And in next video, we are entering the most important capital budgeting technique, that is net present value, or popularly called as the NPV. From here, capital budgeting becomes more professional and more practical. We will understand concept of NPV, time value of money, discounting factors, and why NPV is considered one of the best method in financial management. So don't miss the next session. Thank you all. Follow Curious Commerce. Stay curious. Stay ahead. This is Curious Commerce. Like, share, and subscribe. If you need daily updates, follow WhatsApp channel Curious Commerce Financial Management Hub. Once again, thank you all.